The biggest threat facing banks today is not other community banks, not credit unions, it's fintechs, and it's fintechs by a long shot. That includes neobanks, payment apps, and now a slew of crypto companies who are lining up at the OCC to secure their own national trust charters to exploit new territory made available by the Genius Act. Back in 2021, fintechs were only capturing about 17% of what's called consumer switch flow. Those consumers that are either net new to banking or they're switching from another financial service provider. Last year, fintechs captured 43% of consumer switch flow. In the same time frame, in 2021, community banks were capturing 11% of that flow. Last year, they captured only 3% of that flow. So if you're leading a bank and you're trying to understand what the 3 to 5 year future looks like for your bank, it's important for you to know who you're actually competing with. And if you're distracted by the delusion that it's the financial institution down the street, you've got a massive blind spot that you have to redress and correct. To capture Gen Z relationships in the long term, banks need to do 3 things and do them really, really well. Number 1, they have to get creative with real-time payments and transfers using debit cards. Debit cards are the preferred payment mechanism of Gen Z. Number 2, they have to get really fiercely efficient on account opening. Specifically, they have to provide under 3-minute mobile-only account opening that does not require a manual KYC challenge. And then that process should end. You should divorce it from account funding. Then you give them a timeline, 30, 45, 60 days, in which they can fund that account using any other fintech or third party where they may have funds stored. And those funds are accessible by way, guess what, of the debit cards that all of those third parties have provided to Gen Z. And then finally, wealth tech. Gen Z loves to watch their money grow. They're very, very interested in investing in all different stripes and flavors. So if you incorporate wealth tech into your digital platform, or even better, provide fractional share rewards on debit card spend, now you're putting all of these elements together into a package that Gen Z can't resist. If banks really want to make the most of AI, they've got to have the requisite data to execute on the most compelling use cases. The first thing they have to do is to get their own internal data house in order, which is to say, take their fragmented, disparate, siloed data and unify it, literally bring it together in the form of a data warehouse or a data lake, or yes, even a data lakehouse. That is a real thing. Once your existing data is unified, cleaned, normalized, and ready to be fed to an AI model, a machine learning algorithm, maybe even a series of agents, you're cooking with gas, except with one big asterisk. Do you have enough data to do the use cases and to create the value for your customers that you want? Most banks only have, at best, 20 to 25% of their existing customers' total financial data, which means they have massive data deficits to plug. And the way to plug those deficits is open banking. By getting aggressive with open banking rails and securing the data aggregation permissions from existing customers to aggregate back to bank the missing data to get to what we would call minimally viable data, now you can pursue the most compelling use cases and value creation for your customers. The best and only way for banks to measure ROI on tech investments is to have a clear window into the data representing the impacts of those investments. That means you can't have your data sitting in disparate silos in very discrete and separate systems of record. All of that data has to be brought together into one source of truth, preferably real time in feeding, so that the bank leadership can, in real time, also see the impact of whatever the latest technology project or investment has been. This is the only way for banks to get an actual feedback loop on their technology investments and be able to see either the efficiency gains or the growth from those investments.